Tesla just posted the best second quarter in its history. 480,000 cars delivered, up 25% from a year ago. That blew past what Wall Street was looking for by roughly 74,000 vehicles, and the stock fell about 7% anyway. We've also got a brand new 3-row Model Y, the energy business quietly hitting another near record, dueling analyst calls on where deliveries head next, and more. This is the Tesla Brief, after the close on July 2nd. Welcome to the show. A quick look at the stock. Tesla closed down 7% at $393, while the Nasdaq was down about 0.8%, and the S&P 500 finished basically flat. So this was almost entirely a Tesla story. The broad market barely moved, and Tesla dropped hard on a delivery number that, on paper, looked terrific. Let's unpack why, because that gap is the whole episode. Start with the number itself, because it settles an argument that's been running for 2 years. Tesla delivered 480,126 vehicles in the second quarter. It produced 451,758. Wall Street's consensus was sitting around 406,000. So this came in about 18% higher than what analysts expected. And it's the strongest year-over-year growth Tesla has posted since September of 2023. There's one number underneath that's just as important. Days of inventory. Basically how long a finished car sits before someone buys it, dropped from 29 days in the first quarter to 17. Cars are moving off the lots much faster. For the last couple of years, the loudest bearish argument on Tesla was that demand had collapsed, that the company could build cars but couldn't sell them without cutting prices. A number like this, with inventory shrinking at the same time, is about as direct a rebuttal of that argument as you'll get. So why did the stock fall 7% on what was by any normal measure a great quarter? This is worth explaining slowly, because it trips people up every single earnings season. There are really two consensus numbers floating around at any moment. There's the official Wall Street estimate, the one Tesla technically reports against, and the one the headlines use, which was around 406,000. And then there's the whisper number, the higher figure that traders and prediction markets have quietly talked themselves into by the time the report actually lands. In the 5 trading days before this print, Tesla stock had run up about 12 to 13%, while the Nasdaq was up only 4%. Prediction markets like Kalshi were showing bull estimates as high as 472,000. So by the time the real number arrived, the market had already priced in something huge. Against that whisper, 480,000 barely cleared the bar. As Bloomberg's Al Root put it, Tesla reported exceptional second quarter delivery results. They just weren't exceptional enough for the stock. When expectations have already sprinted ahead of the news, even a genuine beat can get sold. There's a second layer to it, and it's a fair one. 2 things helped Tesla's demand this quarter that may not repeat. Gas prices were higher during the quarter, which pushes some buyers toward electric. One widely followed Tesla analyst estimates that alone added around 5% to demand. And the drag on Tesla's brand from Elon's role in Washington faded after he stepped back in May. Strip both of those out and the growth is still real. But the market is now asking how much of it was a one-time tailwind and how much repeats. So a strong quarter got treated as a reason to sell, not a reason to pay up for the stock. That question, does the growth continue or was it borrowed, is exactly where the analyst community split today. And it's a genuinely useful disagreement, because both sides are reading the same quarter. Gene Munster at Deepwater Asset Management called it, in his words, a monster delivery number. His framing? The EV winter that started in March of 2024 is ending. Tesla had 9 straight quarters of year-over-year declines before returning to plus 6% growth last quarter, and now plus 25%. Even after he backs out that gas price help and the Elon effect, he figures underlying growth was still north of 20%. And his forward call is the interesting part. Wall Street is modeling Q3 deliveries down 9% against a tough comparison, but Munster expects roughly flat, which would be meaningfully better than the street. For next year, he sees 10 to 15% growth. Munster also made a point that ties the whole business together. Every car Tesla sells is another node collecting real-world driving data. So the car business and the Robotaxi business are, at the data level, the same business. More cars on the road means more miles feeding the self-driving system. On the other side, a well-known and increasingly cautious Tesla investor read the identical number and reached the opposite conclusion. His argument, the 2 things that just helped Tesla, high gas prices and Elon fading from politics, are both about to reverse. Gas prices are already back to normal, and the boost from Elon leaving Washington is largely used up. So in his view, demand softens from here, not accelerates. Same quarter, opposite calls on the next two. And neither side gets proven right by this print. The answer shows up in the Q3 number, 3 months out. Alongside the delivery number, Tesla launched a genuinely new product in the US today, the larger Model Y, which it's calling the Model Y L. It starts at $61,990 for the launch trim. It's a 3-row, 6-seat vehicle built on a stretched Model Y platform, 7 inches longer, with captain's chairs in the middle row and a genuinely usable third row, heated seats and all. Range is 325 miles, 0 to 60 in 4.4 seconds, on an 88 kilowatt-hour battery. First US deliveries land in October. This matters for 2 reasons. First, it plugs the widest hole in Tesla's US lineup. Until today, the only 3-row Tesla was the discontinued Model X, which means every family that needed 6 seats was walking into a Kia or Hyundai showroom instead. Now there's a Tesla answer. Second, it ships with what Tesla calls PowerShare, bidirectional charging, which lets the car send power back out. It's only the second Tesla in the US, after Cybertruck, to have it. And it quietly turns the vehicle into a home battery. Tesla also launched it in the UAE today. And notice the timing. None of this showed up in the Q2 delivery number. It's a Q3 and Q4 story. The energy side is where Wall Street keeps undercounting Tesla. Battery storage deployments came in at 13.5 gigawatt hours, the second best quarter ever, though it was a slight miss against expectations of about 14. Over the trailing 12 months, deployments are now 49 gigawatt hours, and total cumulative deployments have passed 130 gigawatt hours. Here's the number underneath that almost nobody watches. Tesla's current annual output is running at only about 54% of its installed production capacity, roughly 90 gigawatt hours across its factories, and that's before the new Houston megablock plant even comes online. In other words, the energy business has the room to nearly double on the factories that already exist. One Tesla analyst put it in terms Wall Street tends to ignore. Convert those batteries into the equivalent of car-sized packs, and Tesla effectively sold another 653,000 vehicles worth of batteries, up 29% from a year ago. The point isn't the accounting trick. It's that a business growing 3 to 4 times faster than the car business is still treated as a rounding error in most models. A few quicker items to round things out. The rest of the industry reported today too, and the pattern is worth holding on to. Rivian delivered 12,194 vehicles, beating estimates, and raised its full-year guidance. Its shares were up about 6%. Ford went the other way. Total US sales down about 10%, and its pure electric sales collapsed 41%, with its electric F-150 pickup, the Lightning, winding down to just over 2,000 units. Lucid delivered just under 4,000, up 19%. The pattern, the two companies built from the ground up for electric, Tesla and Rivian, both grew and both beat, while the legacy carmaker trying to bolt electric onto a gas business fell off a cliff. Ford's chief executive is now asking the government to rewrite trade rules to favor US-built vehicles, rather than outcompeting on the product itself. On the analyst front, Dan Ives is leaving Wedbush after 8 years to launch what he's calling a modern merchant bank, spanning technology, energy, infrastructure, and financials. For Tesla investors, that's a small but real change. Ives has been the most quoted bull on the street, carrying some of the highest price targets on the stock. His calls came with a formal rating and a broker's oversight behind them, and got folded into the official consensus. His views will still land in the media, but they'll carry the weight of a fund manager's opinion rather than an official Wall Street rating. It's a small piece of a bigger theme today, the fading authority of the sell-side consensus. And on the macro side, one data point actually matters for Tesla. June jobs came in at just 57,000, against expectations of 114,000, a big miss, and the prior month was revised down as well. The labor market is clearly softening, and inflation expectations in the bond market have been drifting lower. That combination makes interest rate cuts more likely, and rate cuts tend to lift fast-growing stocks like Tesla more than the market as a whole. The next read on that is the Fed's decision on July 29th. Which brings us to what actually decides this. The Q2 delivery number was strong, but it left the biggest questions open, and both of them get answered soon. The first is the Q2 earnings call, confirmed for July 22nd, streamed live on X. That's where we find out whether the profit on each car held up while deliveries grew. Because if Tesla drove some of this demand with price cuts, the margin line will show it. It's also where any concrete update on the Austin Robotaxi service and the next version of full self-driving would land. And those are the pillars really driving how investors value this stock. The second answer comes a bit later, the Q3 delivery number, 3 months out. That's the one that settles the argument we heard all day today. The bulls say the growth rate continues. The cautious camp says it was borrowed from gas prices and a fading brand headwind. This quarter's print doesn't resolve that. The next one does. And somewhere in this window, Tesla says it'll deliver its 10 millionth vehicle, a milestone worth marking, even if it's not what moves the thesis. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.